position. However, what we need to take a look at is what happens, as I told you, to a person purchases an option. Now we are selling them that option. We are the seller. And there's two rules of the market as far as options go. Number one, they will fluctuate in price, and number two, they will always expire. And we take advantage of both of those absolute rules of the option market. And that's what makes this strategy so powerful. Number one, it fluctuates in price. Well, as you can see, we have lots of room to move. Right now, we're about in the center of this little tent. This is, I explained what this white line is. That's our current profit and loss position. Well, we're currently in a losing position. However, the maximum profit on this position is represented by this green line. The green line is what happens to that option at expiration. And as you can see, if you take a look at this down here in this corner here, if the options were to expire today, we would make a maximum of $1,249 on this position. It's 5/17/08, and we have $1,252 in potential profit in this position at expiration. Today is 4/22, and we have a loss of $79 so far today. If we hold this to expiration, remember what I told you back here, these options slowly will decline in value until they get close to the expiration date, which is the third Friday of May. That's what this green line represents, the third Friday of May. Eventually, this white line will continue to go up and go up and go up and go up until it meets this green line in which we've achieved our maximum profit. And that's how monthly income is derived from the markets. By selling options to people who want to buy them, who are taking bets basically on a stock, whether it's going to go up or down, and it doesn't matter. To us, it doesn't matter. If the stock goes up or the stock goes down, we make money both ways. Our maximum actual profit position will change depending on the price of the stock itself. So we may have a little bit more profit or maybe have a little bit less profit, but we take advantage of one of the major undeniable rules of options is that they will fluctuate in price. Number two, we take advantage of the second rule of option trading and that is that all option contracts expire. Once they expire, they either become worthless, or if they have intrinsic value, if they're in the money, they do have some value left to them. We take advantage of those options that are generally out of the money, that have a low probability of actually being worth anything at all, and capturing that so that we can make money. Now, does this work out all of the time? Well, it does and it doesn't. And the reason I say that is because prices do fluctuate. For example, if you put this trade on and then all of a sudden the prices ran up very, very high and all of a sudden they were very close to your break-even point, what would you do? Well, you'd be in a losing position. Also, if you were far from expiration or if you were close to expiration, then you might show a small profit here. And the real key to making the system work is adjustments. Adjustments are everything because, as I said, prices fluctuate. And that's one inviolate rule of the market. Prices will fluctuate. We don't care if they go up or down, but they do fluctuate. And once they get close to our break-evens, then we have to adjust our position so that we do not go into a losing position. There's a couple rules of the option markets, and that is that the two I've already told you. The third one is don't lose money. Okay, so yes, the rules are prices fluctuate, options expire at a date in the future, and the third rule is don't lose money. So in order not to lose money, many times we have to do adjustments to our original positions, and this is where a lot of option players make a mistake. They do not adjust their positions. They put a position on, they believe that they can just keep it on there until expiration, and then walk away from the position. Well, they forgot about the other rule of the market, and that is prices will fluctuate. Yes, they do expire, and that's where if you're an option writer or you're doing credit spreads, you can make money. But what most people don't realize is that not only do options expire, but they also fluctuate. So if you get into a position, and a lot of option players do this, they just put positions on and they forget about them, and they don't even look at them until they have a loss. And then it's too late to do any type of adjustment to that position because they're already too far gone. Our goal is to monitor your positions, put these positions on within 30 to 40 days to expiration, and then we will show you exactly what you need to do in order to adjust the positions when the prices fluctuate to the point where you're going to be in an unprofitable position. And that's where the majority of the real profits come in this business.